Welcome, students, to this masterclass explainer on financial markets. I am so thrilled to have you here today because we're going to tackle something that will fundamentally change how you look at building wealth. We aren't just going to crunch numbers today. We're actually going to dissect the human mind. The goal, to figure out exactly how to dodge those biological traps that sabotage our portfolios and instead build a truly disciplined financial future. Okay, let's dive right into it.
Here is our official course syllabus for today. We're going to master 5 core concepts. 1. The behavior gap. 2. Fear and greed. 3. Avoiding the hype trap. 4. Contrarian indicators. And 5. Your wealth checklist. Nailing these 5 pillars is absolutely crucial. It's the key to going from a stressed-out, reactive market timer to a highly disciplined, successful investor.
Section 1. The behavior gap. Retail investor shortfall.
To kick things off, we really need to confront a massive paradox in the investing world. Why do markets win while average investors lose? Really think about that for a second. Despite the tremendous compounding growth of the market over the decades, everyday people somehow consistently fall way behind. How is that even mathematically possible when the asset itself is growing? Well, the hard data from the Delbar quantitative analysis of investor behavior study paints a pretty brutal picture. Imagine you dropped 100 grand directly into the S&P 500 30 years ago and just left it alone to compound. It would have grown to over $1.8 million. But what about the average equity fund investor? They turned that exact same $100,000 into just about $1 million. That is a staggering difference. The market was handing out a massive bounty over those 3 decades, and the average investor basically left almost half of it sitting right there on the table. And that brings us to this incredibly important number, 44%. The average investor ended up with 44% less than the stock market. Financial author Carl Richards perfectly calls this the behavior gap. Look, this devastating shortfall isn't because the markets are somehow broken or rigged against you. Actually, scratch that. It's not the market at all. It's the extremely costly result of us, as humans, doing frankly dumb things with our money. We just relentlessly buy and sell at literally the exact wrong times.
Section 2. Fear and greed, emotional investing. Let's uncover the psychology behind that massive 44% loss. The truth is, it all comes down to our ancient survival instincts. As students of market psychology, you need to deeply understand that our brains just aren't wired for modern financial markets. Evolution built us to seek security and run away from pain. And that leads directly to something called availability bias, where we use the most easily accessible information to make critical decisions. When the news is screaming about a global crisis, our survival instinct kicks into overdrive, we panic, and we sell our assets low out of pure fear. But on the flip side, when our social feeds are flooded with people getting rich quick, boom, we buy high out of intense greed. We totally overreact to whatever is loudest right in front of us instead of looking at the big picture. And honestly, this leads to one of the funniest yet most tragic results of that greed, the greater fool theory. This simple napkin sketch by Carl Richards hits the nail on the head. You've got this Venn diagram where doing something dumb completely overlaps with hoping someone else is dumber. That is exactly what happens when retail investors buy an insanely expensive asset, not because it has actual underlying value or cash flow, but purely hoping a greater fool will inevitably come along and pay even more for it later. It's just an emotional gamble masquerading as an investment strategy.
When we contrast institutional professionals against retail investors, the differences are night and day. Professional managers act like emotional circuit breakers. They're relying on highly disciplined, deep dive research conducted by chartered financial analysts. Retail investors, on the other hand, are usually out there acting on superficial tips, intense FOMO, the fear of missing out, and engaging in high-cost reactive trading. The pros have built strict systems to manage their fear and greed, whereas retail investors basically let fear and greed manage them.
Section 3. Avoiding the hype trap, the dangers of FOMO. Let's look at a real-world disaster to seek exactly what happens when retail investors climb the mountain of hype without a professional guide. The 2021 electric vehicle sector boom was an absolute masterclass in FOMO. Retail investors came rushing in, completely blinded by exciting headlines and an avalanche of social media buzz. They were paying massive, totally unjustified premiums for these trendy new EV startup stocks. The hype was absolutely deafening, but the actual underlying business fundamentals, they were entirely ignored by the public. The brutal reality that followed is pretty stark. On one hand, you had the cash reserves of these highly touted EV startups just falling off a cliff from their IPO all the way to the end of 2023. And at the exact same time, their cash burn in 2023 alone was massive. So while retail investors' stock prices had initially shot to the moon purely on euphoric emotion, the actual companies were literally burning through cash at an alarming, completely unsustainable rate. When the hype inevitably completely faded, those stocks suffered brutal corrections. Retail investors who bought at inflated prices hoping for a greater fool simply got wiped out. That right there is the ultimate danger of timing the market based on hot tips.
Section 4. Contrarian indicators. Buying the pain. So how do we counteract this hype and panic? Well, here is the secret weapon professionals use. I want you to literally burn this number into your memory. Positive 43.6%. That was the S&P 500's actual return in the 12 months following the terrifying April 2020 pandemic crash. Think back to how scary the world felt in April 2020. Panic was absolutely everywhere. Yet, if you invested right at that moment, you captured immense growth. It proves a really profound, entirely counterintuitive truth. The absolute best time to invest is almost always when it feels the most painful to do so. And historical data from Osborne Partners tracking the Consumer Sentiment Index against S&P 500 returns proves this over half a century. When consumer sentiment is sky high, meaning everyone feels perfectly safe and greedy, subsequent market returns are usually pretty low. But check out what happens at the low end of the spectrum. Whenever consumer sentiment drops below 70, like when the public is genuinely terrified and pessimistic,
The average return over the next 12 months explodes to over 18%. Low sentiment is a contrarian indicator. Bad feelings historically mean absolutely fantastic buying opportunities. The big takeaway here is that trying to exquisitely time market tops and bottoms is just a fool's errand. As research from the Bank of Singapore clearly shows, missing just the best 1% of trading weeks completely destroys your long-term returns. Time in the market always beats timing the market. Patience, not prediction, is how you truly compound wealth over decades. Section 5. Wealth Checklist. Steps for Success. All right, class, let's pivot to the solution phase of our masterclass. It's time to hand you your actionable syllabus for financial success. But before we get to the checklist, we've got to acknowledge that a huge percentage of large-cap domestic equity funds actually underperform the S&P 500 year after year. Why does this systematically happen? It's because of high mutual fund expenses, excessive trading fees, and a total lack of control over year-end tax distributions. These unmanaged hidden costs practically guarantee you're going to underperform. You absolutely have to focus on managing what is entirely within your control. So here is your 4-point wealth checklist inspired by Osborne Partners to help you take that control back. Step 1, education and awareness. Deeply understand your own biological biases and remember the contrarian indicator. Be greedy when others are fearful and fearful when others are greedy. Step 2, deep research. Stop relying on casual tips. You've got to look closely at the actual cash flow and business fundamentals of an investment. Step 3, cost and tax management. Ruthlessly minimize transaction costs and avoid those highly taxed expensive mutual funds. And step 4, create a long-term plan. Commit to a structured strategy that entirely ignores the 24/7 news cycle and is built to weather the inevitable volatility. I want to highlight this absolutely fantastic quote from Carl Richards to validate all this. Doing the right thing is simple. Maybe not easy, but simple. Look, keeping your fear and greed in check during massive market chaos, that is emotionally incredibly difficult. It literally goes against millions of years of human evolution designed just to keep us safe. But the mathematical roadmap to success, diversifying, managing your costs, and patiently holding long-term is completely straightforward. I want to conclude our explainer today by challenging you with this final, provocative thought. Take a really hard look at your own portfolio and your own habits. Are you managing your future based on a disciplined, well-researched, long-term plan? Or are you just playing the greater fool, jumping blindly from hype to hype? Take immediate, structured control of your financial destiny today. Thanks so much for joining me for this masterclass. Class dismissed, and I'll see you in the next explainer.